All right, today we're tackling a huge investment question. Do you go with the tangible security of real estate, or do you jump into the explosive potential of crypto? These are two completely different worlds, and both are vying for our attention. So just imagine for a second you have a choice. A physical property you can actually see and touch, or a digital asset that's completely rewriting the rules of finance. It's a tough call, right? And the answer is definitely not as simple as it might look. So first up, let's talk about crypto. Why is there so much buzz right now? Well, it starts with some really positive momentum. The market has been flashing some pretty strong green signals lately. And the data really speaks for itself. I mean, look at these numbers from just a single week. You've got solid gains across the board. Bitcoin and Ethereum are climbing nicely, but then look at Solana, a nearly 17% jump. That's the kind of thing that really makes investors sit up and take notice. But what are these things, really? Let's break it down with some simple analogies. Think of Bitcoin as digital gold, basically a place to store your wealth. Ethereum is more like a giant global computer where people build all sorts of apps, from decentralized finance or DeFi to digital art, NFTs. And Solana? Just picture a super fast multi-lane highway designed to make everything run way faster and cheaper. And make no mistake, this isn't some niche hobby anymore. We're talking about massive global adoption. Over 600 million people around the world now own some form of cryptocurrency, and more than 200 million of those own Bitcoin. That tells you this is becoming more and more mainstream. So, with all these people jumping in, where could this be headed? Well, some professional market analysts are throwing out some pretty bold predictions. They're forecasting a Bitcoin price that could shoot past $250,000 by the end of 2025. Now, of course, you've got to take any forecast like that with a grain of salt. And then you've got some really bullish takes. The well-known analyst Plan B is suggesting we could see a doubling pattern, hitting $160,000 in 2025 and then maybe even $320,000 in 2026. It's just one viewpoint, for sure, but it shows you the kind of optimism that's out there. Okay, so all this energy around crypto kind of forces us to step back and rethink what we consider safe versus what we consider risky. So let's bring real estate back into the conversation and see how they stack up. There's this really interesting idea gaining traction that frames Bitcoin as digital real estate. The thinking here is that it's not just a currency, but a valuable, finite piece of digital property, kind of like owning land, but in the digital world. And when you look at it that way, you start to see a very different picture of risk. With crypto, the biggest risk is pretty obvious. It's price volatility. Everyone knows it goes up and down. But with real estate, the risks are often hidden. Things like it being hard to sell, super high taxes, and all the money you have to sink into maintenance. This leads to what some people call the real estate trap. You buy a property, maybe take out a big loan. The value goes up on paper, which is great, but then you try to sell, and suddenly you're hit with high taxes or you just can't find a buyer. The result? Your valuable asset is stuck, and you can't get your cash when you need it. So after comparing all of that, what's the big takeaway? It really seems to come down to redefining your whole investment strategy and making sure you're seeing the full picture for any asset. Look, the bottom line is this. Every single investment has trade-offs. The things we think of as safe, like real estate, can have these hidden traps. And the things we see as risky, like crypto, might have some clear advantages, like being able to sell it quickly whenever you want. And so, it all comes down to this one question you have to ask yourself. Is my portfolio really ready for the future? Is it balanced enough to handle not just the obvious risks of new assets, but also the hidden risks of the old ones?